Welcome. In this video, Zbcn coin has formed a bullish pattern. Is the attack starting? We will analyze it. Don't forget to subscribe and like, and please watch to the end to understand. Such a descending curve is generally considered an important indicator in technical analysis, showing that the price has been consistently declining over a certain period and that the market is under selling pressure. Descending curves serve as critical reference points for investors and traders to understand price movements, because when the price breaks above the curve, it typically indicates that the current downtrend has ended and a potential upward move may begin. At this point, the price breaking above the curve is not only a short-term movement, but also a significant turning point that affects market psychology, liquidity levels, and investor perception. The continuous downward movement along the descending curve demonstrates the strength of the selling pressure and shows that buyers have not yet fully gained control. For investors, this represents a period to be cautious because the price has not yet exited the downtrend. However, breaking above the curve signals a major shift in market dynamics. This breakout point indicates that buyers have overcome selling pressure and are pushing the price upward. Therefore, investors can monitor this breakout to identify potential buying opportunities. From a technical perspective, breaking a descending curve generally allows the price to first gain small upward momentum, which then strengthens and carries it to higher levels. This breakout also impacts trader psychology, as seeing the downtrend end restores confidence in the market. The price that breaks the curve becomes a critical reference point for both short-term and long-term investors, and the movement that follows will help determine the direction of subsequent trends. From a market psychology standpoint, the descending curve represents investors' fear and uncertainty. While the price remains below this curve, most investors lean towards selling, and a general sense of pessimism prevails. However, when the price breaks above the curve, it signifies overcoming this psychological barrier. In this scenario, investors re-enter the market and buying strength increases. Consequently, the downtrend ends and the foundations of a new upward trend are laid. This psychological shift reinforces the post-breakout movement and contributes to the formation of upward momentum. Breaking a descending curve also becomes more meaningful when considered alongside technical indicators. For example, if volume increases as the price breaks the curve, the strength and validity of the breakout are enhanced. Simply surpassing the curve is not enough. The volume supporting this movement also indicates the likelihood of trend continuation. If volume supports the breakout, the probability of a sustained rise is high, providing investors with reliable buying opportunities. The price that breaks the curve typically experiences a short consolidation period before continuing its upward movement. During this process, market participants test whether the breakout is confirmed. If the price returns above the curve after minor pullbacks, it is considered a strong signal that the trend is continuing. Therefore, breaking a descending curve is not only a technical move, but also a multifaceted event that influences market behavior. For investors, the point at which the descending curve is broken is important for assessing potential risks and gains. The price breaking the curve indicates that buyers have taken control and selling pressure has decreased. At this point, investors can take positions using appropriate risk management strategies and evaluate the potential start of an upward trend. Especially for short-term traders, this breakout represents a critical level where quick profit opportunities may arise. Breaking the descending curve also reshapes support and resistance levels in the market. The price that breaks the curve may first test the breakout point as support, and then target new resistance levels. This process redefines the market structure and provides the foundation needed for the price to continue moving upward. The movement of the price that breaks the curve often carries the potential to rise back to the point where the previous downtrend began. From a technical analysis standpoint, breaking a descending curve is considered a critical signal that can shape many investor strategies. This breakout can change the direction of the market and trigger upward movement. In other words, the price breaking the curve not only ends the current trend, but also opens the door to a new upward trend. Therefore, investors should monitor this breakout and adjust their strategies accordingly. In conclusion, such a descending curve represents critical market structures reflecting selling pressure and a downtrend. The price moving above this curve is highly significant from both technical analysis and market psychology perspectives. The price breaking the curve demonstrates buyer strength, reduces selling pressure, and allows for the initiation of a new upward trend. For investors, this point marks potential buying opportunities with the most favorable risk-reward balance. Breaking the curve is seen as the start of upward movement, and the subsequent process is expected to continue the rise. We cannot rely solely on the curve for analysis. Let's look at other metrics as well. Stay tuned. The MACD indicator is an extremely critical tool for investors and traders to understand price momentum, trend direction, and potential reversal points. This indicator allows us to analyze market strength and direction by observing the relationship between short-term and long-term moving averages. The basic principle of the MACD is to examine the difference between two different moving averages and interpret how this difference changes over time. In this context, an upward crossover of the MACD lines is considered a very important signal in market dynamics and indicates the potential for the price to initiate a bullish move. An upward crossover occurs when the short-term moving average crosses above the long-term moving average. This indicates that buyers are starting to gain control over selling pressure and that market momentum is turning upward. Technically, this crossover serves as a reversal signal because the price can break away from the downtrend and begin a new upward movement. The MACD lines crossing upward also reflects a psychological shift in the market toward buyers and shows that investor confidence is increasing. Strengthening momentum in this way suggests that the price movement will not be limited to a short-term move, but may also signal the beginning of a broader upward trend. The MACD functions as a momentum indicator, helping us understand the direction and speed of price movement. When the lines cross upward, the accumulation of market energy and buyers' interest creates the dynamics needed to push the price higher. This crossover is considered a strong signal, supporting investors' decisions to open positions, as historical data shows that prices often rise significantly following an upward MACD crossover. The upward crossover process of the MACD is not limited to the lines crossing each other. Histograms also play an important role during this crossover. The histogram visually represents the difference between the MACD lines, and an upward increase confirms strengthening momentum. Rising histogram values indicate accumulated volume and energy supporting the price's upward movement. This is considered a critical indicator for investors because it increases the likelihood of a bullish attack and strengthens the probability of trend continuation. From a technical analysis perspective, an upward crossover of the MACD lines is considered a buy signal by many traders. This signal allows the price to overcome short-term resistances, reach new levels, and use current market momentum in the upward direction. When the crossover occurs, the price's upward movement usually accelerates as buyers enter the market and selling pressure decreases. Therefore, an upward crossover of the MACD lines acts as a strong catalyst that triggers investor positions. Additionally, the upward crossover of the MACD lines positively affects market psychology. When investors see this technical signal, they may accelerate their buying decisions, which further supports the price's upward movement. Psychological factors are as important as technical indicators because overall market behavior is shaped by investor decisions. The MACD upward crossover indicates growing confidence and buyer pressure, helping the price rise more steadily and allowing investors to adjust their strategies accordingly. When the price moves upward along with the MACD's upward crossover signal, the sustainability of the trend is further strengthened. In this scenario, the price first tests short-term resistance levels and then breaks through them to reach new heights. The crossover of the MACD lines serves as a technical trigger and helps the price gain momentum. When this momentum is supported by market volume, the bullish trend can be longer lasting and more sustainable. The MACD upward crossover also plays a decisive role in shaping investor strategies. This signal represents an opportunity for both short-term traders and long-term investors to open positions or strengthen existing ones. Trend-following investors can particularly use the MACD upward crossover as a reliable entry point. This increases the potential for the price to move upward and creates opportunities for investors. In conclusion, an upward crossover of the MACD lines is extremely important from both technical analysis and market psychology perspectives. This crossover shows that buyers are gaining strength, selling pressure is decreasing, and the price is ready to move upward. The MACD signal provides investors with a clear idea of the trend direction and confirms that the momentum necessary for a bullish move has developed. The crossover allows the price to gain momentum and test new upward targets. This helps investors shape their strategies, manage risks, and maximize potential gains. Along with the upward MACD crossover, the price movement is considered one of the strongest signals to follow in technical analysis and a clear indicator of the market's upward energy.
The flag pattern is a classic and highly effective chart model used in technical analysis to describe structures where the price experiences a short-term consolidation or correction, followed by a potential strong continuation in the direction of the prevailing trend. When this pattern forms during an uptrend, it is referred to as a bull flag and is considered a strong signal that the existing trend will continue if the price breaks above the upper line. The main characteristic of the flag pattern is that the price becomes compressed within a short-term horizontal or slightly sloped channel. This compression indicates a consolidation period in the market where investors review their positions and a temporary balance forms between buyers and sellers. The pattern itself consists of two main elements: the flagpole and the flag portion. The flagpole represents the rapid price movement preceding the pattern, and the height of this movement is used to determine the target the price could reach if it breaks the pattern. The flag portion represents the period in which the price fluctuates within a short-term horizontal or slightly sloped band, and momentum begins to accumulate. A break above the upper line in a flag pattern is the most important technical indication that the trend will continue. This breakout shows that buyers have taken control of the market and selling pressure has temporarily decreased. Once the upper line is broken, the price typically moves an amount equal to the height of the flagpole. This movement sets a measured target for the pattern and clearly defines potential profit opportunities for investors. The flag pattern acts as an energy accumulation point, enabling the price to move quickly and powerfully after a short-term consolidation. When the price breaks the upper line, this energy is released and the price moves toward the target with investor interest. The impact of the pattern is significant not only from a technical analysis perspective, but also from a market psychology standpoint. During the formation of a flag pattern, investors typically maintain their positions, make buying and selling decisions cautiously, and the market waits at a certain equilibrium point. This waiting changes dramatically when the price breaks above the upper line. Investors taking positions at the moment of this breakout allow the price to move by an amount equal to the height of the flagpole. Therefore, the flag pattern is a critical indicator for investors, both for short-term opportunities and for understanding the trend's direction. Technically, when a flag pattern breaks, the price reaching a target equal to the flagpole's height is also supported mathematically and statistically. The height of the flagpole determines the measured move of the pattern, and the probability of the price reaching this level is high. This enhances the reliability of the pattern and helps investors make more solid position decisions. Additionally, volume changes during the flag pattern confirm the validity of the breakout. Decreasing volume during consolidation and increasing volume at the breakout indicate that the price is likely to move by an amount equal to the flagpole's height. The flag pattern is a classic model that indicates the continuation of a trend after a short-term correction, and a break above the upper line triggers this continuation. For investors, this pattern allows for clearer risk and reward analysis. The measured target of the pattern enables investors to see potential gains and risks in advance. When the price breaks above the upper line, it is evident both technically and psychologically that buyers control the market, allowing the price to move toward the target. The price breaking the flag pattern and reaching a target equal to the flagpole's height is generally related to market momentum and energy accumulation. The flag pattern represents a period where investors observe short-term consolidations and make decisions. Once the breakout occurs, this accumulated energy is released and the price moves by an amount equal to the flagpole's height. This demonstrates both the technical reliability of the pattern and the potential profit it offers investors. The flag pattern is particularly effective in uptrends, and a break above the upper line is a strong signal that the trend will continue. This breakout indicates that buyers have increased control in the market and selling pressure has temporarily decreased. The height of the flagpole sets the target the price can reach after the breakout, providing a clear profit opportunity for investors. The pattern acts as an energy accumulation point, enabling the price to move quickly and powerfully after a short-term consolidation. A price breakout of the flag pattern is important both technically and psychologically. Investors see this breakout and open positions, allowing the price to reach a target equal to the flagpole's height. This process increases the reliability of the pattern and helps investors shape their strategies. The flag pattern indicates the continuation of the trend after a short-term correction and creates opportunity zones for investors. With the breakout, the price reaching a target equal to the flagpole's height is also supported mathematically. The height of the flagpole determines the measured move of the pattern, and the likelihood of the price reaching this level is high. This enhances the pattern's reliability and its strategic importance for investors. Additionally, volume changes during the flag pattern confirm the validity of the breakout. Decreasing volume during consolidation and increasing volume at the breakout indicate that the price is likely to move by the flagpole's height. In conclusion, the flag pattern provides investors with short-term opportunities and serves as a strong indicator for understanding trend direction. A break above the upper line allows the price to reach the measured target equal to the flagpole's height and helps investors shape their strategies. This breakout releases the market's momentum and energy accumulation, supporting the price to move quickly and powerfully toward the target. The flag pattern is considered a reliable indicator where technical analysis and market psychology work together, and it stands out as one of the most important signals for trend continuation.
Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.